Greetings, all you 99 percenters. This is your host, Dr. Jack Rasmus. This is Alternative Visions. Okay, well, the big news this past week, of course, was a couple days ago, the big plummet, I guess you would call it, collapse. We'll see, but certainly a major decline in the U.S. stock markets. I'm talking about all of them. The Dow was down 831 points in the middle of the week. Yesterday, Thursday, dropped further, not as much, as investors are trying to figure out what's going on. Is this just a temporary correction, or is this the end of this incredible stock market, which enriched the 1% unimaginably? Oh, the other markets, NASDAQ, which is the tech market, and S&P 500, which is the top blue-chip stocks, were down even proportionally, percentage-wise, even more than the general Dow Jones market. Overnight, on Thursday, Japan stocks dropped even more, as did Hong Kong and China. China's stock correction underway here, or had already begun, even greater than it has been since 2015, when the market crashed by 50% in China. Okay, so it looks like there's signs of contagion. What about emerging market stocks? Well, they were already in retreat here in Latin America, as the currencies in those economies were collapsing because the dollar was rising, because the Fed was raising rates. You see, this Fed raising rates has a lot to do with this, because it became clear this past week that Fed rate hikes were now spilling over into the bond markets. And bonds took a big jump. Bond yields, interest rates, in other words, which meant that bond prices, which move in opposite direction, took a big plunge. Okay, so the thing going on here is involving stocks and bonds and Fed and currency exchange rates and so forth, and now we're beginning to see all that impact financial markets, particularly stock markets right now, and bond markets. So, big drop in U.S. stocks. As I had predicted last March, remember we had a big 1,000-point drop, and I said, this means that investors are getting skittish, but that's a dead cat bounce that's going to follow, and of course it did for the next 5 months, 6 months, but now we have another major correction. The big question is this another one-time off, and we're going to see another run-up, or is this, an indicator of something more fundamental, and we're going to see impacts here before the end of the year, particularly if the Fed keeps raising rates. Well, as I've been saying all along, the Fed is not going to raise rates 4 more times, one time here in December coming up, and then 3 more times next year, as it said it would. It can't do that without precipitating a credit crunch and a big pullback in all the financial markets, and it's not going to do that, I don't believe, and have said it won't, because the U.S. economy cannot absorb an increase in the Fed benchmark rates above 2.75, maybe 3%. Right now the Fed rate, which is the benchmark rate, all of the rates move in tandem with it, is at 2.25. This recent increase a couple of weeks ago, where Fed Chairman Powell said more is coming, right? The 4 more. Well, that was finally absorbed by investors and say, whoa, wait a minute, we can't, we're going to pull back. Well, why? Why are they so sensitive now? 2.7530 at the max, which means another 1, maybe 2, more likely only 1 more Fed rate hike. Why? The last time in 2008, the Fed raised interest rates to 5.25% before. This was early 2008, by the way, before it precipitated the financial crisis at that time. The Fed and its performance and its policies always overreact. It overreacted in 2008, kept raising interest rates when the economy was really already way overexposed, and it precipitated, did not cause the crisis, but it precipitated it. It was the signal. And the Fed will do it again. The Fed always raises rates too fast for too long, and just as when there's a crisis, it lowers rates too slow and not long enough. Well, it did long enough last time, but too slow. All right, this is all covered in my book, Central Bankers at the End of Their Ropes, where I produced last year, where I predict that the U.S. economy, Fed was going to raise rates, but it couldn't sustain rates higher than 2.7530 in the short-term benchmark rate. Okay. All right, so we got this big signal here in the financial markets, particularly stock and bond markets, that, things are getting fragile. Right? And we will see in the next few days whether this is a one-time, one-off kind of an event, or whether it represents something more fundamental. Well, Trump is kind of worried. Now he's attacking the Fed again, saying, what are you doing? Powell, what are you doing? Powell is the chairman of the Federal Reserve. You're raising too high, too fast. Well, as I've said before in this show, the Fed has to raise interest rates, because how is it going to finance the $1 trillion a year in rising U.S. budget deficit caused by Trump $1 trillion plus tax cuts? Well, actually, it's $4 trillion over a decade. Oh, and Congress is going to make it permanent now, so it's going to be longer than a decade. Well, you got to raise interest rates if you want people to buy your government treasury bonds to get the money to finance the deficit. So Trump has created this problem with his massive tax cuts for investors and businesses in the wealthy 1%, and continuing to ratchet up defense war spending, $100 billion more a year, roughly. And he's asking for more. Well, you're just going to exacerbate the deficit. Those are the two big drivers of the deficit. And now, with interest rates rising, the Fed has to take on more debt itself in order to finance the budget. It's got to raise interest rates, and therefore the cost of financing the debt every year is going to go up sharply as well. Right now it's like $300-some billion, I think. But the Congressional Budget Office has predicted by 2028, when Trump's tax cuts won't expire, we're going to be paying $900 billion just on interest on the debt. The national debt's going to go from $21 trillion to $32 trillion in the next 10 years, and rates are going up. So the amount that the Fed has to pay is going up, and the rates on it are going up. That's how you get the $900+ billion. $900 billion a year just on interest paid to the wealthy who buy the bonds, half of which are in the U.S. and half of which are offshore, banks, central banks, corporations, and so forth, right? Whoa, is that sustainable? No, it's not. But you can thank the tax cuts. By the way, Trump is not the only big tax cutter here. These big tax cuts have been going on since George W. Bush, actually, even before that under Clinton and Reagan. But the big run-up has been since Bush. Bush, $4 trillion in tax cuts, mostly to corporations and investors again. Obama, over $5 to $6 trillion. We've talked about the details of that before on this show. And then Trump comes in with another $4 to $5 trillion. Well, you can't cut taxes like that. Taxes account for 2/3 of the deficit, tax cuts, or the lack of tax revenue due to slow economic recovery, which was under Obama. 2/3 of that deficit are due to tax cuts. The rest are due to spending increases. But they will make you think that the spending increases have to do with Social Security and Medicare, which is not true. It's not entitlements. It's defense war spending. It's the government having to pay out tens of billions of dollars more under Medicare and Medicaid for prescription drugs going through the roof. Over $50 billion a year, you see, is the cost of prescription drugs, and nothing's being done about that. Right? There was no tax passed to finance Part D of prescription drug plan in 2005. It all was designed to come out of the budget, therefore adding $50-60 billion a year to the deficit. Another $50-60 billion a year for Homeland and future security. $900 billion a year for Pentagon and defense and war. Pentagon $650-700 billion of that $900 billion, but there's other costs in other departments, Atomic Energy Department, Veterans Affairs, so forth, that run that whole bill up for wars past, present, and future to $900 billion a year. Well, we're going to be paying $900 billion a year in interest on the debt itself. I'm just talking about the federal national government debt. I'm not even talking about state and local debt. Who knows how big that is? Okay? All right, so why did we have this correction here? What's the significance in the stock markets, U.S. and global? Because all these financial markets now are connected, integrated globally. You see, the same investors who invest in the U.S. stock markets are investing simultaneously in the Asian and European and emerging market stock markets. They're all the same guys. They're what I call the new finance capital elite, global. You know, there's about 200,000 of these people whose annual income, not wealth, income, is $5 to $25 million each a year. 5 to 25. To get in that 200,000 group, you know, the new finance capital elite, global, you got to your investments have to throw off at least $5 million a year, and they do. I wrote about those folks in my prior book, Systemic Fragility in the Global Economy, chapters just on shadow bankers and the finance capital elite. Okay? All right. So, let's get back. Why did we have this amazing run-up in stocks? Not just in the U.S., but everywhere else. Well, because a wall of money was thrown at the financial markets after 2008-9, a wall of money. And, of course, it was thrown into the laps of wealthy investors and corporations, and they just funneled it back into the stock and bond markets, which made them even more money. You see, that's what's called financialization of the economy. Instead of the money going into building real assets, you know, structures and plant and equipment and so forth, some of it went there, maybe 1/5, but 80% of it went into financial markets or went offshore into emerging markets, which boomed after 2008-9. It didn't go where it's supposed to go. See, it went offshore or went into financial markets, or it was just hoarded on balance sheets of the rich. A wall of money. Well, how much was this wall of money that went into financial markets in the U.S., causing the S&P 500 stock market not to double, not even to triple, to quadruple. A quadrupling of the S&P 500 since 2010. And Dow and NASDAQ even more. And the Dow, you know, broader stock market, at least doubling, tripling. Well, why did stock prices rise so much? Well, it was the wall of money. Well, where did the wall of money come from? Well, the Federal Reserve Central Bank pumped $5 to $6 trillion into the economy simply by its one program called quantitative easing. They say it's $4.5 trillion on the Fed QE program, but that doesn't count all the reinvesting in the bonds that the Fed was doing as those bonds matured, you see. They just kept rolling them over. So actually, they pumped somewhere between $5 and $6 trillion into the economy, the Fed. Into the economy means into bankers and into corporations and investors. Okay, that's what really happened. Okay, so where else did the money come from? Well, we talked about the tax cuts. All right, Bush's $3.7 trillion, 80% which went to investors. Obama's initial $300 billion recovery program, 2/3 of that went to investors and businesses. Then he extended the Bush tax cuts for 2 more years after they were supposed to expire. That was $450 billion a year. Then he passed $800 billion more at the end of 2010 when the economy was not recovering, all tax cuts. And then he agreed in 2013 to extend them for another 10 years to cost of $5 trillion. And then here comes Trump. Another $5 trillion to investors. They offset that by raising taxes on the middle class, you see, and making phony assumptions about economic growth that supposedly will reduce the deficit, but it won't. Okay, so, that's the big reason. Tax cuts, Federal Reserve, trillions and trillions of dollars flowing into the coffers of the bankers and corporations and wealthy investors. And then with interest rates so low, all this was supplemented by corporations issuing their own corporate bonds. Record corporate bond issuance, $1 trillion a year, when you add up all the corporate debt a year for every year, because interest rates were so low. Companies like Apple, which have $250 billion in cash, were issuing bonds in order to raise more cash that they would then use to buy back their stocks and pay out dividends. Okay, stock buybacks and dividend payouts, also $1 trillion a year. Of course, stock buybacks, $600 billion a year, that goes directly into the stock market, right? Dividends to their wealthy shareholders, a good part of that goes back into the stock market, reinvested. Some of it may go in bonds, some of it may go offshore. So, $1 trillion a year in buybacks and dividend payouts drives up stocks. Corporate debt borrowing drives up stocks. Fed, $6 trillion, $5-6 trillion injection. Wall of money. And then tax cuts, mostly for investors and corporations, all on top of that. This year, it's estimated that the stock buyback dividend payouts are going to be somewhere between $1.3 and $1.5 trillion given back to the corporations and the wealthy. On top of all this, we got the Trump tax cuts, which was a subsidy, of 20-25%, hitting corporate profit bottom lines. Yeah. Well, corporate profits up 23% this year. Well, the effect of the Trump tax cuts was roughly about 20-21%. In other words, all the profit gains this year are from the windfall, from the Trump tax cuts. Okay, you add all this up and there's a wall of money. A literal wall of money has been thrown at investors and bankers and corporations since 2008-9 crash. Once again, to summarize, the Fed, $5 to $6 trillion. The Bush, Obama, and now Trump tax cuts worth more than that in terms of trillions. Corporate debt issued by corporations, raised money, diverted back into stocks. Doubling, quadrupling of profits back into stocks, buybacks, dividend payouts. All right, all of that was the wall of money that drove stocks to this historic level that cannot, could not, will not be sustained. Yeah. Okay. Now that has come to an end, or is about to come to an end, or the realization of investors is that a lot of that is about to come to an end. And that realization is what is beginning to sink in with investors. All that money was driving the demand for stocks, driving up the value, the price of stocks. But now those same forces have been weakening, and now the realization is finally set in with a lot of investors that, the party may be coming to an end. Interest rates are going back up, so corporations aren't going to issue as much corporate bond debt. Of course, the Trump tax cuts are going to continue, but the Fed is raising its interest rates as well, and QE is being withdrawn, which is driving interest rates even higher. So the Fed role and the bond market role in subsidizing the stock markets is over. But the tax cut windfall is still there. In fact, you should think of the Trump tax cuts as the emergency solution to keep the game going, you see. When the Fed started raising rates, the signal was, and this was in like 2016-17, the signal was, okay, the free money from the Federal Reserve as a form of monetary subsidization of financial assets and stocks is coming to an end. And that's why the subsidization shifted from monetary policy, the Fed, to fiscal policy, tax cuts. This is how they keep it going, you see. They go back and forth between monetary policy and fiscal policy. And the realization is that these 20-25% profit gains every year, which also drives stock prices, is going to come to an end next year. Maybe 10% profit increase. But even the 20-25% was mostly tax windfall, you see. Right. The buybacks are going to slow. Right. The corporate debt issuance is going to slow. Trump tax cuts will remain, but it won't be as, we won't have the triple whammy here of buybacks, dividend payouts, corporate debt issuance, and tax cuts. Well, I guess it's a quadruple whammy, right? If you put in low Fed interest rates, which are over. All we got is the Trump tax cuts next year, and savvy investors know this. They see it and they know it. Plus, the impact on corporate profits forecast is going to be more negative next year. Oil prices are rising. They're $80 a barrel, going up. By the way, interesting historical parallel here. Let me go off on a tangent a little bit. Oil prices, right? When was the last time oil prices were $100 a barrel and more? Well, I'll tell you when. 6 months before the 2008 crash. That's when. There's a correlation between accelerating oil prices and recessions. And of course, oil prices are now rising. And of course, they are hitting the pocketbook of the average household significantly. Most of the inflation going on has to do with oil price increases and increases due to Trump tariffs that are now beginning to bleed into the economy. Okay, so corporations are looking at their 2018 profits subsidized virtually totally by the tax cuts, and they're looking into 2019. Investors always look ahead, and they're saying, oil prices are rising, going to cut into corporate profits as the cost of energy rises, right? Fed rates are rising. By the way, there's an interesting article, I think it was in the Wall Street Journal or Financial Times a day or so ago, that said investors are professional investors are concerned about the fact that so much debt has been taken on by mid-sized non-financial corporations in the U.S., and as rates keep rising, there's concern that they're going to be able to roll over and refinance that debt. We're already seeing defaults. The canaries are singing in the coal mine. Who am I talking about? Sears. Sears announced bankruptcy. Yeah, that had an effect on investor consciousness, I'm sure. We saw Toys R Us go under. Right? Bed Bath & Beyond is going to go under. J.C. Penney isn't going to make it. And who knows what else lurks. Companies under the radar there. And corporate defaults are because rates are too high for weak companies to be able to survive. And these zombie companies have been kept alive since 2008 by the very, very low interest rates. Sears was a loser back in 2008, losing money. It's lost money every year since. Why? Why is it alive if it's losing money for 10 years in a row? Well, because it's been able to borrow super cheap money until recently because of very low Fed interest rates. You see, that's what kept it alive. Well, there's thousands, maybe hundreds, tens of thousands of companies like Sears out there, small, medium-sized companies. And when these rates go much higher, another reason why they can't, you're going to see them take a deep six. And they're already recognizing it. Like over half of the, I think it's called the Russell 2000. That's a mid-sized company stock exchange. Over half of them are overextended on debt. And as rates rise, and a lot of it is variable interest rates. So as rates rise by the Fed, their rates, what they have to pay on debt, rise. And they reach a point where banks and others will not refinance them because they know they're not going to be able to survive to pay off their loans. Then they got a default. Then they go under, you see. And that has a big psychological effect on investors, further impact on investors. Okay, so rising oil prices, rising Fed interest rates, the tariff war is now beginning to bite into certain sectors' profitability, raising raising prices, inflation, right? The tax cuts will fade a little bit next year. And then on top of it, it's not just rising costs that are going to impact corporate profitability next year, but it is evidence that corporate sales are going to be in trouble. Why? China is slowing down. Therefore, demand for goods by the Chinese is going to slow down. Emerging markets, economies are in trouble. Their demand for U.S. goods is going slow because they just don't have the money. And Europe is stagnating again.